trained some sentiment engines. We used an IDIES model, single layer perceptron, support vector machine, and so on. So this is what the sentiments look like over time for the market. Okay, you can see they're pretty highly correlated over time. And then we asked a simple question: is this tweet sentiment driving the market, or is the market driving this tweet sentiment? And what do you think should be happening? Who should be driving whom? Would you go ahead?
The market should be driving.
The market should be driving, right? Now, it would be crazy if the tweet sentiments drove the market, right?
Yeah,
that would be crazy.
In some cases, like Bernie Sanders said, the tweets that would drive the market.
Okay. So intuitively, you would think that the markets, as they go up, people are tweeting, oh, I made money, I'm happy, right? So you would think that the market should drive the tweet sentiments, right? And so we use a very simple test, the Granger causality test. We want to see what's driving what, right? So here are our results. And all you have to do, there's two panels here. There's a left side and the right side. And the columns are different sentiment engines. And you're just looking at the stars next to it. Anything with 2 stars is the p-value less than 0.05, which means it's statistically significant. You can reject the null hypothesis, right? On the right-hand side panel, it says the null hypothesis is the market does not Granger cause sentiments, right? So you can overwhelmingly reject that hypothesis. So you're right. You know, the market drives sentiment, as you would expect. Now, for one of the classification algorithms done by support vector machines, we have some evidence here that actually the sentiment is driving the market, which is kind of interesting, right? So we investigated that further, and we came to the following. The orange line at the bottom, this is the p-values of a rolling Granger causality test. The orange line should be low for the market, and it is, because we know that the markets drive tweet sentiments. And the blue is the p-values to see if the tweet sentiments are driving the market. And this is really interesting because here you see there's a period in 2015, although limited, where the tweet volumes were actually driving the market. And anecdotally, some of our friends on Wall Street were actually making money trading tweet sentiments with the market. And you can see later on in the latter part of 2015, the relationship starts to break down, so it's no longer statistically significant. A couple of different explanations. One, a lot of people started to figure out this trade, so they started trading it. When too many people trade the same signal in finance in Wall Street, it doesn't work anymore because the markets are efficient. So this is evidence showing that it did work. However, the story that we're telling, it is no longer working now, so you're going to have to come up with some other sort of more sophisticated strategy. So, you know, we found a link between equity market behavior, IPOs, and earnings. Lurking underneath that was something much more interesting, which was a relationship between stock price returns and tweet sentiments over time, and that was the introduction of the new factor. And also, we finally documented that market-wide tweet sentiments cause markets to actually move. It gave hope for the traders. However, it was very, short-lived because ultimately the efficiency of the market prevailed. All right, so that sort of makes sense. So what are we doing now? This. It's going to be really exciting. So I want everyone. We'll probably do it on SciServer if we have enough support and space and nobody gets angry at us. Machine learning has amazing tools. So right now, I'm going to teach a big data machine learning class in the business school. And so that's pretty exciting. It's going to be the first time we're going to have this class. What we're thinking about doing is building a fintech AI that actually trades the market. Because we have sentiment engines, we have data, we also have different ways to sort of incorporate this data into particular models. Mixing cross collaborations across Hopkins, big data, huge computational resources, and domain expertise. This is an amazing way to sort of do research, and I'll echo the first speaker about how interesting it is working with people in a different domain. It's very, very interesting. Some of the input data that we expect to put into this AI will be obviously graphs and news and text and pictures and videos and sentiments, even geo-positioning of tweet information, and also the typical fundamental and technical variables. So, warning everyone, the Terminator is coming to trade against you, but this is not going to happen for some time. So that's some of the things we're working on. So with that, thank you for your time.
So I have a hypothesis for how that sixth sense worked. So let's assume that the sentiment you're getting from sampling tweets.
Yes.
Was that you? Okay.
It's my no,
Okay.
no.
That the traders and people who buy and sell and whoever does make the market, that they're represented in the tweets. That tweet is tweets are surrogates for what they're thinking.
Yeah.
And so therefore, if their tweets are bullish, then they probably are bullish too, right? So
Yeah.
it's kind of you're actually getting a surrogate sample of the people who actually make the trades.
That's exactly right. So basically, you have these two things that are literally on top of each other, right? So you have tweets, positive sentiment, and market going up. And how we explain it is that it's not like one always drives the other. Okay, so the relationship, sometimes they're on top of each other. Sometimes one is driving the other. Most of the times the market is driving the sentiment. But every now and then the sentiments may drive the market. But it's not a relationship that's stable in time. So it keeps changing. That's why it's difficult, right? And our evidence right now was only looking at the market-wide, which is S&P 500. So you probably still can trade individual stocks with sentiment analysis, right? But you have to be very, very careful. That's our hunch, right? So this relationship, as in most things in finance, it's once you find it, it doesn't keep repeating, right? That's the difficulties in finance.
So I have a bit of a thought experiment. So what would happen if everyone built like a perfect trading machine? Like what would happen to the markets then?
So what happens, so this is a really interesting question. If everybody built the same machine,
Not the same one.
if everyone built a different machine, okay, fine, you know what? I would bet in that situation, a human trader would make money if the human trader knew everybody else was a machine, right? And so it's kind of fascinating because why? Because the machines are going to behave as historically, they should behave. Whereas the humans can kind of game that, right? So, I think an AI in the markets will only work as long as there's enough human traders out there, right? Once the market becomes overpopulated with AIs trading, then the strategy will be being a human being is going to be better, right? I mean, it depends on the algorithms that you use, right? I mean, sometimes the markets get, we had the flash crash where everybody was trying to trade a particular way, and there was one algo in particular that was trying to hedge too much, right? That, there wasn't enough constraints on it. But, I think we're still real early stages into this, right? I mean, I don't think this is going to happen anytime soon. This will be, I hope, years away before, they can actually program. I've worked at some hedge funds, and we try to build quantitative models that trade, and we would always have to adjust them. So you could never just launch one model and do nothing. You'd have to go back because it stopped working. Initially, it would work for a while, and then it would decay. The alpha would decay, so you have to go back and revisit it and change it and research it and so forth, right? So it's a very difficult thing to do. But I do think, given some of the tools that are readily available in the machine learning sort of industry, they haven't really been used to the extent they probably could, right, to try to build this thing. At least not to my knowledge. There may be some hedge funds around Caltech that are doing it.
Renaissance.
Renaissance.
Is the most popular hedge fund.
Renaissance.
And it's Jim Simons, who's a mathematician. He hired a lot of PhDs in mathematics.
Yes. So I teach an advanced hedge fund course, and the best quantitative hedge funds are Renaissance Medallion, bar none, right? They've generated a historical track record. Nobody can come close to them, right? It's an amazing feat what they've done. But even their strategy is capacity constrained. What that means is you can't just dump unlimited amounts of money on that strategy, right? So you know, they're probably the closest to it, but, you know, I don't know too many people who have any insight in there, right? But I think they're probably the closest to it if there's any.
Have you tried to correlate individual Twitter contributors or classes of them with possible correlations?
Yes. So the number of followers, how good are you at predicting the market, right? Your track record, absolutely. There's been some work done that those people, you can follow the right sort of the authors of these tweets, because some people have a little better track record than others. Absolutely. That's a good thought.
So in the 1990s, Alan Greenspan blamed irrational exuberance for market volatility. So one shudders to think what that might do in the social media age.
No, absolutely. So, like I said, you know, this is our, you know, a long-term vision to do this. If it took, you know, about 4 or 5 years to do the tweets and find the relationship, I imagine it's going to take at least more than a couple of years to actually build an AI to trade financial markets. But, you know, it's a challenging goal nonetheless. And what's great about being in the Ivy Tower, you can try a lot of different ideas, right? So you can have time to think about this problem and try to figure it out.
So could you possibly tell, so you say you look at different time period, could you possibly tell when the tweets going to drive the market? Because now you are doing like lots of multiple testing, like you probably need to justify the multiple thing. Like,
Okay, so great question. So imagine a stock is trading, and all of a sudden someone starts tweeting about this particular stock. And the volume starts to increase because a lot of people are trading the stock. And the tweets are being retweeted. If something is not real, usually it's not retweeted. So the crowd's going to say, it's not real, because they're going to confirm it. But suppose it is real, right? If some company in Oklahoma can create a new energy source out of dirt, right? And all my friends in Oklahoma, I'm from Oklahoma, they start tweeting about it. Oh my goodness, Chesapeake Energy just figured out how to make energy out of dirt. You know, buy the stock, right? Then everybody in Oklahoma, when they see that, they're going to start tweeting it, and then that's going to grow. Chances are people in New York City at that particular time is not going to know that information. So there will be an advantage, an informational advantage in Oklahoma. So to the extent that that thing starts growing in terms of the tweets, the followers, the retweets, and it starts driving the price up, there is a good trade. Because you're getting a piece of information that's not widely disseminated into Wall Street or across the US or across the world, right? So that's an example. The other example is that, God forbid, someone, you know, does something to Kevin Plank at Under Armour, right? But chances are people locally in Baltimore will figure that out first, right? And they may start tweeting about that. Oh my goodness, Kevin Plank, you know, passed away or something, right? And that's going to have a poor effect on the stock market, right? But what you have to sort of appreciate is the information comes out. Do you have the advantage in terms of timing before that piece of information is widely dispersed across the marketplace? And that's the key, right?
All right. Thank you very much. So